All right, let's dive into a financial maneuver that, on the surface, seems to bend the rules of logic. We're talking about a company that pays off its debt not with cash, but by literally giving away pieces of itself. How in the world does that work? Let's find out.
So this really is the central puzzle, isn't it? Can a company, one that's struggling to pay its bills, actually manage to report a profit just by issuing its own stock? I mean, it sounds totally backward, right? But believe it or not, the world of accounting has a very specific and kind of surprising answer.
So here's how we're going to break it all down today. First, we'll set up the problem. Then we'll look at the solution, this debt for equity swap thing. We'll get into the core rule of fair value, walk through the actual journal entry, cover a few key exceptions you have to know about, and then wrap up with why this all really matters to the bottom line.
Okay, so let's set the scene. Just picture a company, any company, and they've got this huge bill staring them in the face. It's due, but there's a big problem. They are cash-strapped. They just can't write the check.
And let's put a number on it. On their balance sheet, there it is, plain as day. A financial liability with a carrying amount, that's just the official accounting value on their books, of exactly $1 million. That's the mountain they have to move.
So with cash completely off the table, the company has to get creative. They go back to the people they owe money to, the creditor, and they renegotiate. They pitch a totally different kind of deal. Instead of cash, they offer up the one thing they can create out of thin air, shares in their own company. And this move has an official name, a debt for equity swap. It really is exactly what it sounds like. The company gets rid of a debt, and in exchange, the creditor gets a piece of the company's equity, a slice of ownership. It's a way to settle up without a single dollar leaving the bank account.
Now, this is where it gets really interesting for us accountants. You've got this $1 million liability on one side and this new block of shares on the other. How do you actually record that in the ledger? Do you just say the debt is gone and call it a day? Is it a simple one-for-one trade? Not quite.
Well, luckily for us, we don't have to guess. There's a specific piece of accounting guidance for this exact scenario. It's called IFRIC 19. Think of it as the official rule book that tells us exactly how to handle this. And the first, most fundamental principle that IFRIC 19 lays out is this. Those shares the company is handing over, they aren't just some abstract concept. They are treated as the actual consideration paid. In the language of accounting, the shares are the payment.
Okay, so if the shares are the payment, the next obvious question is, how much is that payment worth? IFRIC 19 gives us a really clear two-step process. The number one go-to method is to measure the fair value of the shares you're issuing. You know, what they're actually worth in the market today. Only if you absolutely positively cannot figure that out reliably do you use the fallback method, which is to measure the fair value of the debt itself.
So let's bring this back to our company. They do their homework and determine that the reliable fair value of the new shares they're about to issue is $800,000. Now pause right there, because this is the critical moment. They are paying off a $1 million debt with a payment that is only worth $800,000. And now for the main event. Let's get into the mechanics and actually book the transaction. This is the journal entry where that seemingly impossible profit is born.
The logic behind it is actually super simple. You can think of it in 3 steps. Step 1, measure your payment, the fair value of the shares you issued, so $800,000. Step 2, compare that payment to the debt you're wiping out, which is $1 million. And step 3, whatever that difference is, you record it straight into profit or loss. Let's build this journal entry together. First, we need to get that liability off the books. So we debit financial liability for the full $1 million. Poof, it's gone. Then we need to record the new shares we created. That's a credit to equity for their fair value, $800,000. But wait a second, our debits and credits don't match. We're missing a $200,000 credit.
And that balancing figure, that's the punchline. It's a $200,000 credit that gets recorded as a gain on extinguishment. And IFRIC 19 is crystal clear. This gain flows directly to the profit and loss statement. So there you have it. The company, because it couldn't pay its debt, just manufactured a $200,000 profit for its income statement.
Now, hold on. Before you think this is some kind of magic accounting loophole, it is absolutely critical to know that this rule doesn't apply to every situation. IFRIC 19 has some very important exceptions.
So yeah, you can't just use this anywhere. For example, if your creditor is already a shareholder and they're acting in that role, this guidance is out. Same goes if the deal is between two companies that are basically controlled by the same parent. And finally, if the option to swap the debt for equity was baked into the original loan contract from day one, well,
a different set of rules applies entirely.
So, let's zoom out. We've been deep in the accounting weeds, but why does any of this actually matter? Why should an investor or an analyst care about this one specific rule?
You don't have to take my word for it. The standard itself says it right here, plain and simple. That difference, that gain we calculated, shall, and that's a strong word in accounting, shall be recognized in profit or loss. It's not hidden away somewhere, it hits the income statement directly.
So here's the ultimate takeaway. A single non-cash transaction that was born from a company's inability to pay its bills can actually create a significant artificial-looking boost to its reported profits for the period. It's an accounting entry that can dramatically change the story a company's financial statements are telling.
Which leaves us with a final, really important question for you to think about. Next time you're looking at a company's financials and you see a big gain from extinguishing debt, what's your first reaction? Is it a sign of clever financial management, a smart way to fix the balance sheet? Or is it a massive red flag, a symptom of a company in such deep trouble that it ran out of cash? The accounting entry is just the start of the story. The why behind it is what really matters.